Welcome to this explainer. If you've ever stared at the dense, seemingly endless pages of IFRS 9 and literally felt your eyes glaze over, well, you are definitely not alone. Today, we're completely demystifying this standard by tracking the exact life cycle of a financial instrument. We're going to follow an asset or a liability from the very second it's born on the balance sheet, figure out its unique identity, watch what happens when it gets a little sick with credit risk, and finally, look at how it gracefully, or maybe not so gracefully, meets its end. Let's just dive right in.
Okay, here's our roadmap for today. We're going to cover the evolution of IFRS 9, scope and recognition, classification, impairment, derecognition, and lastly, we'll wrap up with hedge accounting.
Section 1. The evolution of IFRS 9.
So IFRS 9 definitely wasn't born overnight. It actually replaced the old IAS 39 standard in these really distinct, careful phases over 13 years. You see, the board always wanted to replace IAS 39, but because financial markets move incredibly fast and everybody was demanding quick fixes around the 2008 financial crisis, they decided to release it in chunks rather than making everyone wait for one massive heavy rulebook. We got the classification rules in 2009, hedge accounting rolled out in 2013, and finally the complete, fully baked version dropped in July 2014. And honestly, looking at the actual text of the standard, you can immediately see why we need to translate this heavy regulatory jargon into an engaging story. I mean, paragraphs like 1.1 through 7.3.2 lay down all the main principles, but reading it straight through, it's literally like reading a dictionary to learn a new language. So let's abstract this whole thing into our life cycle model, starting right at the very beginning.
Section 2. Scope and initial recognition. Right off the bat, not everything makes the cut. Here is a strict exclusionary list of what actually falls outside of IFRS 9's scope, just so we can set our boundaries. The absolute key takeaway here is that IFRS 9 does not want to step on the toes of other specialized standards. Like if you've got rights under an employee benefit plan, that belongs to IAS 19. Rights and obligations under a lease, that's totally IFRS 16 territory. By carving out these specific exceptions, IFRS 9 makes sure it stays hyper-focused purely on true financial instruments. Think loans, bonds, derivatives, trade receivables, the real deal.
And that brings us to initial recognition. This is the exact beautiful moment our financial instrument is officially born and recognized on the balance sheet. The standard is super clear here. An entity recognizes an asset or liability when, and only when, it becomes a party to the contractual provisions. Not when you're just thinking about it, not during some early casual negotiations, but the precise moment that contract is actually struck. At this point of origin, it's generally measured right at its fair value.
Section 3. Classification and measurement. Now that it's born, it needs an identity. We use this incredibly neat decision tree matrix to figure out exactly how an asset should be classified, based entirely on its business model and cash flow characteristics. This basically tells us how we're going to measure its value over its entire lifetime. IFRS 9 forces us to ask two big questions. Number one, what's the entity's business model? Are they holding this asset just to sit back and collect the contractual cash flows over time, or are they holding it to collect those cash flows and eventually sell it? Question number two, what do those cash flows actually look like? Based on those answers, boom, the asset falls into one of three buckets: amortized cost, fair value through other comprehensive income, which we affectionately call FVOCI, or fair value through profit or loss, also known as FVTPL.
This specific quote right here, this is the absolute golden rule for unlocking those amortized cost and FVOCI categories. We call this the SPIPI test, solely payments of principal and interest. Think of it like checking if it's just a standard, plain vanilla lending arrangement. The principal is basically just the fair value at initial recognition, and interest is primarily your compensation for the time value of money and the credit risk. But if an instrument's cash flows get a little too exotic, or maybe they're tied to volatile equity indexes, well, it fails this test entirely and gets dumped straight into the fair value through profit or loss category.
Section 4. Expected credit loss impairment.
So what happens when our financial instrument gets sick? IFRS 9 introduces this fascinating two-tiered expected credit loss model, where instruments shift from a 12-month loss allowance to a lifetime allowance if their credit risk significantly increases. Guys, this is one of the most massive shifts from the old rules. Under the old standard, we literally waited until a loss event actually happened before recognizing it. Too little, too late, right? Now, at every single reporting date, an entity has to record a loss allowance. If the asset is perfectly healthy, great, you recognize 12-month expected credit losses. But
If that credit risk has jumped significantly since it was born, you've got to recognize lifetime expected credit losses. And the absolutely crucial shift here is moving to predictive, forward-looking information, rather than just passively sitting around waiting for a default to happen. IFRS 9 states explicitly that if forward-looking info is available without crazy cost or effort, you cannot just rely on past due data. You actually have to look at macroeconomic forecasts. Now, the standard does throw us a safety net. There's a rebuttable presumption that credit risk has significantly increased if payments are more than 30 days past due. But in an ideal world, you're factoring in broader economic data way before it ever hits that 30-day mark.
Section 5. The Rules of Derecognition.
Eventually, everything comes to an end. To figure out if an instrument is truly dead and can officially be wiped off the books, we walk through this super strict sequential test. Step 1 is pretty straightforward. Did the contractual rights to cash flows expire? Like if a loan is completely paid off, it's done. End of story. But what if the entity sells the asset? Well, then we hit Step 2, were the rights actually transferred? Step 3, did they transfer substantially all the risks and rewards of ownership? For example, if you sell off a loan portfolio but guarantee to absorb all the losses if it goes bad, well, you haven't really transferred the risks, have you? And if it's still a bit of a gray area, we look at Step 4, who actually has the practical control to sell the asset?
You see, the standard specifically prevents companies from sweeping risks under the rug. If you tried to derecognize an asset, but you secretly still guarantee part of it, or maybe you hold a put option on it, IFRS 9 says, no way. It requires you to keep recognizing that asset to the extent of your continuing involvement, and you have to recognize an associated liability. Basically, if an entity transfers an asset but desperately holds on to control without taking on the risks, that asset stays on life support through this concept of continuing involvement.
Section 6. Demystifying hedge accounting.
Finally, let's talk about armor. Entities use hedge accounting as this magical armor to protect themselves from volatile financial risks. Now, this is entirely optional, but it is incredibly beneficial for matching up your gains and losses. IFRS 9 breaks this protective armor down into 3 very specific, highly regulated types of eligible hedging relationships. First, a fair value hedge. This protects against changes in the fair value of a recognized asset or liability, kind of like fixed-rate debt. Second, a cash flow hedge, which protects against the wild variability in future cash flows, like a highly probable forecast transaction. And the third type? That protects the parent company's net investment in a foreign subsidiary. The whole goal here is just to perfectly align the accounting treatment with the company's actual real-world risk management strategy.
But what if your armor gets a little dented? Well, if a hedge stops being perfectly effective, we can actually rebalance the ratio. This is a massive, practical improvement in IFRS 9. Back in the day, if a hedge drifted even slightly out of its highly effective range, you literally had to discontinue hedge accounting entirely and start the whole process over. A nightmare, right? Now, if the underlying economic relationship is still fundamentally sound, you just tweak the quantities. You adjust the hedge ratio to get things perfectly back in alignment. It's practical, it makes sense, and it actually reflects how risk managers do their jobs in the real world.
So, with all these forward-looking estimates and complex hedge accounting rules, it begs the question, does perfect financial reality actually exist on a balance sheet? Or is it all just a highly regulated prediction? It's a fascinating thought to leave you with, right, at this wonderfully complex intersection of strict accounting rules and messy economic reality. Throughout this explainer, we've seen how IFRS 9 literally forces managers to predict the future, from expected credit losses to highly probable forecast transactions. It totally acknowledges that the life cycle of a financial instrument isn't always black and white. By using business models, forward-looking info, and rebalancing, the standard tries its absolute best to capture true economic reality. What you should really take away from this is that IFRS 9 isn't just a boring list of rules. It's a dynamic, predictive framework designed to keep our entire financial system transparent and resilient. Thanks so much for joining me on this journey today.